We start once again with, you guessed it, new records, more records on Wall Street. Stocks really in uncharted territory nearly every single day now. The S&P 500 closing out its best week since early September. And fun fact, today was the biggest volume day of the year.
Stop.
Quadruple witching. There you go. But things can be a little scary at the top. You're all making money, your accounts are going up, and your question probably is that you're asking yourself and us, how do I position myself as we enter the final trading days of the year and next year when, Guy, it's not just about this year. It's been a heck of an 8-9 year run. A lot of people are probably thinking, do I need to protect myself a bit? Because our portfolio has done very well.
It's interesting you say that. And hi, Brian.
Hi, Guy.
Tim.
Hi, how are you, sir?
CB
Good
Dubs.
to have you. Nice,
Cheers,
thanks
Steve.
for so friendly.
I think for a long time earlier this decade, that's what people did. They bought protection. Then they said to themselves, you know what, why? It expires worthless every time all the market does is go up. Then they stopped. And then they got really creative and they started selling options, which CBW can talk about with the great Dan Nathan, who, by the way, tonight at 5:30 is Dan Nathan's last appearance on Options Action. I want to get that out there now.
He's keeping his options open. Is that what's going on?
See what you did there?
But not on fast money. We look forward to seeing that.
You absolutely, with the VIX at 12 and a half, it makes perfect sense because all the concerns I've had, clearly incorrectly, are still out there. But what has worked and what we have talked about, healthcare continues to crush. Biotech continues to do well. Some of these retail names have been amazing trading stocks like Macy's, like Nordstrom's. And I think Tim would agree with this. Energy has very quietly over the last 2.5, 3 months made a decent move higher.
Yeah, it was another interesting week for central banks. And, we talked briefly yesterday about how the Riksbank in Sweden, don't get too caught up in that. Rates are moving higher. Global central banks, our Federal Reserve, are deciding whether zero interest rate policy, NERP, whatever you want to say, is working. That's actually something that should concern equity markets, but probably not here, except for the fact that this move in equity markets has taken positioning going into year end to the complete polar opposite of where we were almost 1 year to the day. So if you look at the greed and fear index, if you look at the AAII bull bear spread, whatever you want to read, it's almost diametrically opposite of what it was last year. That should concern you in the same way it set things up last year. And I realized no one was jumping in on deck 24 saying it's going to go up and we're going to have a 2019 that we did. But we did. And I think you have to be cautious about positioning.
But Carter, I'm not trying to knock on Macy's. I'm not knocking on oil and gas companies, but Tim mentioned them as like leaders. Do we have to worry this is kind of a low-quality stock rally?
Yeah, it's tough to call one stock a leader after dropping for 3 and 4 years, or a sector, right? But what we do know is that you have catch-up trades always in markets. And I think that when momentum's high, people double back, try to find something that's lagged and play it. And so these are more sort of catch-up trades than they are leaders.
But is it because you think, Steve, they believe, investors believe in those names, or it's, hey, they're down, the market's running,
I think that
let's buy the stocks that are
You started off the show saying,
cheap.
how do you position yourself? I think that it was an over-positioning to be short for trade, for the Fed, and they had to have the catch-up trade going into the end of the year. Q1 is going to be a hell of a time to lay the shorts out again, potentially. It's going to depend on estimates, guidance, and where all of those analysts that called for a earnings recession might ratchet up estimates too high, and then estimates fall short.
Guy, I thought of you this morning.
I'm sure you did.
Wow.
Why was today any different than any other morning,
Because
Brian?
I saw a chart that I thought had Guy Adami written all over it, and it was a chart showing the expansion of the Federal Reserve's balance sheet by $3.5 trillion the last few months. I mean, an incredibly steep and rapid expansion of that balance sheet. Obviously, an injection of liquidity into this market. And if that doesn't continue, which it can't at some point, can the market continue?
Well, I was not here on, I believe it was Wednesday, but I think you had the great Northman trader on, Sven, if I recall, and you had this exact conversation. And we mentioned
he's going to be right. He's going to be right one day.
He's right more than he's wrong, but that's another conversation. But I'll say this. I don't think it can continue. I mean, the fact that we've grown the balance sheet, the Fed, the fastest it's grown in a decade, I mean, at a certain point, it's unsustainable, or the market's going to call them out, or the market's going to say, wait a second, what are you seeing that we don't see? What is your concern? So clearly, that's been a huge catalyst in September. I just don't know how long that can last.
What are they not seeing, though, Brian? What are they not seeing? They're not seeing inflation. I know that you could point out where inflation is in certain aspects of the economy, but the Fed is not seeing inflation, and that's why the rate cuts were more appropriate, and now they're using the balance sheet. They don't have enough ammo with cuts alone, and that's why you see the balance sheet being used.
But how
right
much?
now.
My point in pointing that to the viewers, which they all know, we got the smartest viewers in the world out there, is that this has got to be at least maybe not all, but a part of this market run in the last 90 days.
It is, and we are none the wiser for what central banks can do next year, nor are they. And if you look at what, the last 21 sessions, you can actually see the change in the curve, the steepness that's gone on, the way that the long end has finally bounced off of very important levels. So in other words, bonds have been selling off enough. We've been hearing about foreign selling of foreign central bank selling of U.S. Treasuries. Again, it's not panic time. It's not runaway. I don't think yields are going to get away from us. But I do think that what we're all talking about is a market that's had the euphoria of central bank and the turbocharge of the last 6 weeks or 2 months has been beyond something that we could have expected, especially when the Fed was supposed to be getting out of the way until the middle part.
But they're not getting out of the way. And I'm going to, my heart seeing you guys is 2 sizes too big. And I'm going to play the Grinch.
Wow.
Okay, because January 31st and January 30th or whatever, December 30th and January 2nd, $320 billion being injected into the New York Fed for the repo market. Is that something we need to worry about? I know we keep bringing it up, and it's a broken clock is right twice a day. But if everything was hunky-dory,
of course,
why are we doing this?
Well, there's an expression, the fix is in. And so you call it what you want, but they're taking measures in some form or fashion. And usually when you're taking measures, something's not right.
But why do they have to do this? And I just, I wonder.
Well, that's what we don't know.
Well, and this is scary because if the Fed doesn't know and if the Fed has to react
well, they know, we don't.
Hyperbolic move we've had.
Yeah, but they were too nervous in September, and maybe they overreacted. We don't know. They saw something in the repo market, and they wanted to shoot first and then figure it out. But it was September they were worried. October they took action. So I think that they might have overshot, but I think they wanted to calm everything so that no one, because people were getting worried about that repo market.
Well, do you remember the sort of infamous now Mnuchin letter where he's like, over the weekend, he's like, I spoke to the banks, everything's fine. Everybody's like, why are we speaking to the banks? What do we need to know about here? I kind of feel like that repo market thing is the same way.
And I don't think we've ever really been told as to what are the stresses within the system. But again, even if you're an equity investor at this point, and we talk a lot about how sometimes the credit markets seem to have an edge on the equity markets, it's telling you that you had a free ride for the last 2 months, and you have to be careful about that.